Welcome to Global Money Talk, brought to you by SamProTV. Greetings to all of our viewers from the U.S., Korea, and around the world. We are coming to you live from the floor of the New York Stock Exchange, and I am your host, Remy Blair. We are coming to you live from the financial capital of America in New York City. We'll start out the hour with the market briefing and live coverage of the U.S. markets. For today's market briefing, we have Tai Wong, independent proprietary trader. And in the second half of the show, we'll be bringing you a special segment with Howard Marks of Oaktree Capital. Good morning, Tai. Thank you so much for joining me today.
Good to be here again.
Well, we were here this time yesterday and we saw markets in the red. And in today's trading session, we're seeing mixed trading for the major equity averages. This does come on the heels of PPI figures, producer inflation figures, and jobless claims. But first and foremost, what did you make of the volatility yesterday? Because we did close higher.
What a day. I mean, I think we sat down and the Dow was down 750 points. I think by the time we finished, the Dow was only down 500 points, and it really slowly, methodically clawed its way back for what resulted in a very good day, led by big tech, led by NVIDIA, which was up over 8%. And it seems that the U.S. stock markets will take a punch, but they're indomitable. They just keep coming back. So really a remarkable price action. And what is important about that, if you're a chartist, you'd see that we may be poised for perhaps a new high in the S&P 500. If the Fed is cooperative next week, which is to say that they'll give us 25 basis points and give the market something they want to hear, something soothing, perhaps a dovish outlook. Unclear what that's going to be, but it sets up the S&P very, very well.
And speaking of the U.S. stock averages, Tai, let's take a look at where markets are this morning at the 11 o'clock hour. So in New York morning trade, we're seeing the Dow Jones Industrial Average lower by 0.2%, and the NASDAQ Composite Index is slightly higher on the session, up by 0.2%, but we are seeing flat trading for the S&P 500. Right now, we are seeing the S&P 500 at the 55 level. And as you mentioned, Tai, next week we have the Federal Reserve rate meeting. They kick off their two-day meeting on September 17th, and on the afternoon of the 18th, we get that rate announcement. But while we're on the topic of central banks, I do want to take a step back because the ECB this morning, they cut as expected by 25 basis points. And in addition to that, they did lower their growth forecast. So what did you make of that rate announcement?
So that was perhaps the most well-telegraphed thing we've ever seen. But yeah, we laughed because 68 out of 68 economists said they were going to cut 25 basis points.
Very accurate.
Completely unanimous. So they're telegraphing better than the Federal Reserve. Boy, the Fed likes to not surprise the market, but I guess these folks definitely feel the same way. So they have a little bit of a conundrum, and they're literally going meeting by meeting, because even though inflation is coming down, they found that inflation is coming down, but wages are going up, and wages that that usually will start hitting inflation with a little bit of a lag. So there's concern particularly about services. So they're literally going meeting by meeting. Most economists think they will not move in October, but might move again in December if the wages stay reasonably quiescent. But we're not sure. And then back to, you mentioned a little bit earlier about PPI and our data this morning.
Inflation.
PPI's has been quiet, but generally was higher than expected today, both headline and consensus by a tenth. But the revisions to last month were lower. So essentially, it was a flat reading. Jobless claims, initial jobless claims, pretty steady around the 230,000 initial claims mark. So I think the market essentially is now probably 90% that we're going to get 25 basis points. They're going to try to think about what Jay Powell is going to say, but I think that we're pretty much set in stone in terms of at least the rate move next week.
And while we're looking at inflation figures, I do want to take a step back and look at those CPI figures that came in yesterday. So mostly in line with estimates, but we did see shelter costs or housing inflation in those figures. So when we were talking about this before the show yesterday, we were talking about mortgage rates as well. So Tai, tell us what's happening in terms of mortgage rates here in the United States.
So the average mortgage rate, I think it came out yesterday or the day before, it's 6.29%, and it's a drop of maybe 15 basis points from the week before, and it's the 7th straight week, I think, that the rates have dropped. So, which is really good news. And as a matter of fact, just on a call yesterday, somebody said that a 30-year 5.75% mortgage has gone through, which is quite remarkable because I think most people don't remember the last time they saw a 30-year mortgage with a 5 handle on it. So that's pretty encouraging. Which just brings us to the housing market. One thing about the housing market in the past couple of years that's really surprised people is historically, with higher rates, you get lower housing prices because mortgages are more expensive, so housing, it's harder to sell. But what happened in this case, and it's something that I can't remember seeing, is that because the rates went up so quickly, anybody who currently owned or currently owns a house didn't want to sell their house and buy something else because they'd be trading in. I'm lucky; I have a 3.75% mortgage. If I trade that in, my new mortgage on my new house, if I wanted to upgrade or even downgrade, unless I could pay for it in cash, would be 6.5%, 7%. Who would do that? So you had a situation for a couple of years where rates are very high, but prices are very high because there's no supply on the market. So I think we may hopefully be seeing that market sort of slowly melt down a little bit, where you get a little more supply, where people can afford to buy a new house. First-time buyers can afford to buy a new house, and these existing owners can upgrade to a house at a reasonable rate. We're not there yet, but we could see it if rates continue the way that they go. We could see it perhaps closer to the end of the year, and certainly by the spring selling season.
And Tai, I'm so glad you went into the dynamics of the housing market, because when we think about buying a house or buying a property here in the U.S., rates are key, mortgage rates. And typically in the U.S., you and I, we spoke about this yesterday before the show, but we have rates at 15-year or 30-year when we're talking about these rates. But when it comes to pricing, these are fixed, correct, versus variable here in the United States?
In the U.S., most mortgages are 30-year fixed, although you can get a 15-year fixed if you wanted. And the great thing about the mortgage market here is you can prepay, which means generally you can, if you came into a lot of money, you could just pay off the mortgage. Or if you sell your house, you get rid of the mortgage and you can prepay that, which is great for the consumer. And as well, in this mortgage market, you can refinance. I remember my original mortgage was higher, but I refinanced probably 1.5% lower, and I've held that. I'm never getting rid of that mortgage, especially if I can get, well, not for much longer, but if I can get sort of 5% in a CD or in a high yield savings rate. And I'm only paying 3.75% of my mortgage. Why would I ever touch that? Thing is staying forever. I'm going to pay that down to the last possible date. Some people use ARMs, or adjustable rate mortgages, and they often come in 1.5s or 1.7s, which means that they are adjustable. They're adjustable for up with every year, but usually with a ceiling. It can't go up more than 2 years. And they're 5 or 7 year mortgages, but those can be a little more risky, and nobody's doing those these days because the initial rates are so high. I think people do that when rates are very, very low, thinking that we'll take advantage of. What they'll do is they'll give you a low teaser rate to start, but then they have the optionality to raise that if markets go up. In other countries, you don't really have the 30-year fix like we do. I think in Canada is a little bit different, and the Canadian housing market has had an issue with, because mortgages are so short and people had trouble paying for it. They're sort of extending and praying, and hopefully the market comes back where homeowners who are underwater can continue to pay it. So we're very lucky in this country.
And a 3 mortgage rate, that is something, 3 handles, something that we haven't seen in several years. And we know here in the U.S., when it comes to the housing market, during the pandemic and post-pandemic, we have seen such a sea change in the way that consumers buy shelter or buy housing and property as well as rent. So we'll see how inflation as well as the change in interest rates starts affecting the housing market in coming months. So
I think it will be a long time, if a long time. I hate to say if ever, that we'll see a 30-year mortgage with a 3 handle on it. I do think, and a lot of economists feel the same way. I mean, they feel the same way.
Yeah.
They're much better at this than I am, to be perfectly honest. But that the underlying level of inflation, we used to struggle to get 2% from the downside. It'll be a lot harder for us for a number of reasons to get back to it from the upside now that we may stay between 2.5% and 3% on inflation. One of the reasons is the changing demographics of the country, but the other is we're trying to go for a greener economy, electric vehicles, and all of those things are relatively expensive. So on a broad spectrum, you can easily see how that adds perhaps 0.5% or 1% to underlying inflation.
And we'll have to keep an eye on those numbers, Tai, but it does make me think when it comes to housing as well as EVs, these are issues that are on Americans' mind in this presidential election cycle.
Well, you're absolutely right, because one of Vice President Harris's proposals is to give a $25,000, it was a tax credit, I forget if it was a tax credit or a down payment to first-time home buyers, which sounds great. But if you think about that, if the seller of the home sees, well, they're getting another $25,000, down payment, I think I can probably raise my prices a little bit. So you could, it's sort of the law of unintended consequences, which is really, really powerful. And for those of us in the market, we really respect it, because you touch something and you think something will happen down the road, but you never know how those waves broaden out. So will it boost home prices just when we're hoping that the housing prices ease a little bit to get transactions moving again and people into homes, because that's a big driver of the economy. Right? So you don't really want to maybe mess too much with that. But it's important, and that's why I think she proposed it, because on the face of it, it's great. If you gave me $25,000, that's awesome. And I mean, I guess there's a truism in politics that if you rob Peter to pay Paul, you're pretty much guaranteed the support of Paul. But housing is an issue. That's why governors and mayors, as well as the presidential candidates, are focusing on it.
And absolutely, because you think about different markets, real estate markets, whether we're talking about commercial or residential here in the U.S., and $25,000 here in a market like New York City or the major metropolitan areas versus other areas that may be suburban or rural, that can go much further.
You're
when it comes to
right.
prices.
You're absolutely right. I remember, now it's a few years ago, and prices have gone up since then, but Senator Schumer, Majority Leader Senator Schumer of New York, said, no, in New York City, if you're living in New York City, if you make $200,000 a year, you're just making it.
Yes.
And
that's unbelievable, isn't it?
Isn't it? Isn't it? An apartment, a one-bedroom apartment in a nice condo building in New York City, $5,000–6,000. Those are remarkable numbers. So $25,000 perhaps not meaningful here in the tri-state area, meaningful a lot in various parts of the country.
And if you're in a co-op or condo here in New York City, you have to think about HOA fees or additional fees to that. So that does add more to the total. But moving away from housing, Tai, I do want to very quickly take a look at other markets, including oil, metals, as well as the U.S. currency. So yesterday we saw the yen rise, and today we have the ECB rate decision. So what are we seeing on the heels of today's rate announcement?
So euro dollar barely moved. I mean, literally, I think it moved what they call 10 pips, which is practically nothing. But when the announcement came out, and dollar has been relatively quiet. Bonds are a little lower, yields are a little higher, bonds a little bit lower today. And oil is up for the second day in a row, and this is I think we may have touched upon it yesterday, but the Russians, or President Putin, came out and said we may consider. I'm sorry, might have been Putin's lieutenants said that we may want to punish the world by cutting back on some of our commodity exports, which the world needs, but we don't want to hurt ourselves. They mentioned uranium. I think they mentioned natural gas, but certainly oil was on people's minds. Palladium was on people's minds, and palladium has rallied very, very sharply. It's a metal that's used in catalytic converters. So everybody who has a gasoline engine has palladium in the catalytic converter in their car, and that rallied probably 7 or 8% over the last few days. So I think that that announcement may have gotten out a little bit ahead of time. The one thing I do want to focus on today is gold.
Yes.
Gold has gone up to a new high, a new historic high, trading about $2,550, and there's really no single trigger on it. In the sort of relatively early in the morning, around 9 o'clock or so, we just saw a big volume build up in gold. And what that suggests for someone who's been watching the market for a long time is that there's program buying. So today, if you wanted to buy a lot of gold, if you wanted to add it to a fund, in the old days you would probably call up a salesperson for a bank, and the salesperson would go to say, Tai, where are you in 100,000 ounces of gold? And I'd make a two-way price because I wouldn't necessarily know which way they're going, though depending on who the customer is, I might, and I would make a price. But today they would say 100,000 ounces of gold. Well, we can buy that over, there's no rush, we can buy that over the course of an hour. So if there's 60 minutes an hour, and they just literally slice it and dice it up. So you just get sudden, unexplained, higher volume buying. And that's what we saw in gold. So it really feels like somebody's added to an allocation. And the dollar really hasn't moved. Yields are actually a little bit higher, I think. So gold shouldn't have reacted on this on its own. So there's definitely a program in there. And it's a bull market. There are only really two allowable positions. You're either long or you stand aside, but there's no point in being short here.
And very quickly, since you mentioned yield, we've been focusing in on the yield curve, and tell me what's going on there, because there are concerns about the disinversion, and then right now what is actually happening here. Are you concerned?
Not concerned right now. The disinversion in the past has in recent times has signaled the beginning of a recession. But that has not always been the case. And in the early 80s, we had a couple of, the early to mid 80s, we had a couple of cases of disinversion where the markets, and as a proxy for the economy, has actually done very well. And you could say the early 80s was a time of substantial inflation. And we have been in a time of substantial inflation. So remains to be seen, but I think we may be okay.
Okay, well, very quickly, since we're short on time for today's segment, Tai, I do want to touch upon a story that we have been talking about. So bankers have had to turn in their passports in China. So what is going on here when it comes to that nation and these bankers?
So it was a sort of an amazing headline, especially for Americans who are used to individual liberty. And if you look at it, we have actually more liberty and more absolute freedom of speech than I think exists anywhere in the world. Western Europe, where you can't criticize certain faiths, and religions, but we can practically say anything we want about almost anything that is not, unless it's something really a credible threat. But anyway, getting back to the story, in China they've been trying to clean up the financial sector, and the idea that Xi Jinping, Premier Jinping, says we want common prosperity for all, and it's easy to target people who are rich and have luxuriant lifestyles and have a lot of money. So he's cutting their pay and investigating them. One of their biggest deal makers hasn't been seen in months, and he's cooperating with authorities. And the broader theme of things, when you see things like that, it makes it harder to get the economy going in China again. He said, you have laws like this on one hand, but on the other hand, Xi says, hey, we want to do everything we can to make growth hit our 5% target. You're trying to run in two directions at once. You're not giving the market any confidence. And when a market's not confident, they don't want to do anything. And there was another story where the Wall Street Journal reported that U.S. companies where China is a top destination is down to 15%, and that's the lowest in a 25-year survey. So certainly American companies are still in China, but they're not looking to make any additional investments in China because of the sort of the business climate there. And things like taking away people's passports. Do people even want to be in the finance business? If you're in finance, do you want to be stationed in China or in Hong Kong for that matter? So this is something I think they will have to come to grips with if they do want to resume the growth that they had been used to. But what you're seeing is just really not helping. The headlines are, and certainly, with the Western press, it's not really friendly to China, but the headlines to China are simply not friendly. We had a scandal last week where a top aide to Governor Hochul of New York and Governor Cuomo before him turned out to be a highly paid agent working for the Chinese government. Now, listen, everybody has spies or everybody has agents in there, but that was a little close to home, and this is what people remember. So I think China needs to figure out what they want to do strategically.
Well, Tai, we are all out of time for today, but I look forward to speaking with you tomorrow, and we will see how the market closes today. Thank you for joining me.
It's been an interesting week.
Thank you. And coming up, Howard Marks of Oak Tree Capital will be joining us. We'll be right back. Don't go away.